You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have British American Tobacco, B&M, W.H. Smith's, Hollywood Bowl, Tesco, and our US company of the week is Upwork. Sam, shall I kick us off with the trading update from BAT?
Absolutely, our favourite tobacco company.
Their trading update stated that the group continue to expect low single-digit growth in underlying revenue and operating profit over the full year. This guidance carries forward a second half weighting driven by continued investment in US commercial initiatives, as well as the phasing of new product launches. In combustibles, volume share year to date is up 0.3 percentage points. Value share is down 0.1 points, reflecting geographic mix and commercial positioning in the US, where the industry volumes are down 9%. In new categories, British American Tobacco expects to deliver improved profitability for both first and the full year. The group is targeting free cash flow conversion of over 90% and is on track to bring down net debt within the 2 to 2.5 times underlying cash profit EBITDA range by the end of the year. The shares were down around 1.5% following the statement. In terms of valuation, British American Tobacco has a market cap of £53.5 billion and trades at just 6.5 times forward earnings, compared with a 10-year average of 11.6, and it has a prospective yield of 10%. I don't think there's a huge amount to say about this trading statement. We have got used to the group in the last couple of years having low single-digit growth in underlying revenue and profit for, I think, really since kind of probably maybe 2021, 2022. Before that, it was more your mid to sort of slightly higher single digits. One thing that we've commented on before and that we've seen again in this trading statement is that combustible volumes are down significantly, which is obviously the main source of revenue for the group and where all the profits come from. They have been investing heavily in the new categories, and they're saying, which is obviously positive for the group, that they're expecting profitability by the end of the year, which again is part of the investment case for British American, in that it's an industry in structural decline. The combustibles are not going to last forever. Hence, the future of the business is entirely based on these new categories. I mean, the market, I think, far from being convinced about this. Of course, from an ethical ESG perspective, you've got almost all of the big funds, pensions pulling out of tobacco stocks. So that has significantly depressed the valuation. It remains to be seen whether with the new products, the new non-combustibles, there is going to be a significant re-rating. But I think if you were investing in British American Tobacco, ethics aside, you'd be seriously concerned about the rate at which the combustibles are declining, which I think it really explains that valuation. Sam, what are your thoughts on this statement from BAT?
I agree with what you've said. I think the volume declines in the US are concerning. We've touched on this a few times now, and it does look like it's the start of a trend. I think it's a bit frustrating that this trading statement is a little light on how the non-combustibles is doing, so the new categories. I know it's saying improved performance, but that's pretty vague. I guess depending on how the new categories does, and so far British American's new categories I think has done very, very well to date. But if that can offset a decent chunk of the revenue and profits lost from the combustibles, you can see why the current valuation makes sense, because at a 10% dividend yield, you'll have had all your cash back within 10 years, and that assumes it goes to zero. Even if it goes to zero and you're left with a new categories business that's half the size, you've still kind of won on that. So I think the new category is key to understanding how well it's done in a period now. I do think, although it's a small part, like, it's actually quite a sizable part now for British American Tobacco. I appreciate it's still not the size of the combustibles, but it's getting much bigger and it is growing quickly. I just think that information is key. So I think we probably have to come back and have a look when the full year results are actually out properly rather than the trading statement, so we can see how it has actually done. Because I just think it's so key to the thesis now that the combustibles volume drops are starting to accelerate.
Yeah, so I'm just having a little bit more of a dig. So they say that in Views, which is basically their vape, they maintained global value share leadership at 41.1% in key markets, but they're citing illicit single-use vape headwinds in the US, which are continuing. And then in terms of Glow, which is their sort of heat not burn, they say year to date volume share is down 20 basis points to 16.8%, driven by encouraging early customer response to their new innovations, Glow Hyper Pro.
They're not giving any growth figures.
They're not giving any growth figures.
So we'll have to wait for the full results.
Yeah.
Right. Shall we move on to B&M?
Yes.
So B&M, the value retailer, have come out with their full year results, and revenue for B&M UK was up 8.5%, and that compares to 4% a year ago. B&M France revenue was up 19.2%, and that compares to 22% a year ago. And Heron Foods was up 15.3%, and that compares to 18% a year ago. The adjusted operating profit margin for B&M UK was 12.4% compared to 12.3% a year ago. For France, it was 9.5% compared to 8.8% a year ago. And for Heron Foods, it was 4.9% compared to 3.8% a year ago. I do find it really interesting how much higher margin B&M is compared to Heron Foods.
Yeah,
anyway.
I
don't know if it's just because of what they're stocking, like more homeware and stuff like that.
Yeah,
you go
possibly
in and a lot of it isn't actually. I know they sort of maybe suck you in with the tins and stuff. Or I guess Heron Foods. I don't shop there, I'm proud to say, but it's probably based on the description more food stuff, which will be the lower margin stuff.
Yeah.
Anyway, so the group revenues increased by 10.1%, or 7.8%, including the extra week during the year. All fascias delivered volume growth through positive like-for-like customers' transaction numbers and new space growth. The group adjusted operating profit increased 10.9%, 614 million, with volume-driven profit growth and strong cost controls across the three businesses. Strong post-tax free cash flow of 382 million, that was down from 464 a year ago. With a disciplined approach to inventory management has been highlighted, with group inventory at 776 million, up slightly from 764 million a year ago. They opened 78 gross new stores across the group, and that's 47 in B&M UK, 20 in Heron Foods, and 11 in B&M France. And the net debt to adjusted EBITDA was down from 1.3x to 1.2x, and including leases, it was down from 2.5 to 2.4x. In terms of the valuation, the business trades at a PE of 12.5 and has a dividend yield of 2%. And in terms of the share price, it did peak at over £6 a share during COVID when it was doing very, very well, because I think it was, one of those essential retailers, so it managed to stay open.
They managed to get that status, yeah.
So I mean, it does tend to help business when all your competitors are forced to close. So they were over £6, and then they dropped to about £3. I remember that first year after COVID, the results were quite poor, but the next couple of years since then, they seem to have done quite well. And they're now at £4.74, so they're pushing £5, but they're only sort of 20-25% off the COVID high now, which, considering they were 50% below, they've done quite well. I think these are a pretty good set of results. So total revenue in France was 514 million. That compares to 560 million for Heron Foods and 4.4 billion for B&M. So I suppose maybe there's some growth in France, but I don't know. I imagine it's pretty saturated like it is here, but they've done well over here. So I think at 12.5 times earnings, it's pretty fairly valued. It's actually growing quite well, I think, for a business at 12.5 times earnings. I think you have the optionality that France does well. And I can't remember when we last covered them, but I do remember sort of slating them quite a bit, maybe a couple of years ago, when they did have that post-COVID wobble. But I think we're now starting to see that it obviously is a well-run business, a quality business, and yes, there maybe was some retraction after COVID when people went back to competitors because they were allowed to. But I think it's done pretty well. And it's obviously, in fact, I'll have a look at the financials and see how it's done. Even now after COVID, it's 2020. The results, the revenue was 3.8 billion. It's now 5.5 nearly. So it is a business that has sort of consistently grown over a 5-year period. So yeah, I like it. I think it's a good business. I think there are far worse retailers that you can buy. What about you, John?
Yeah, I think they're very good results. I think it is showing its resilience. I think it is a pretty decent quality business. And at 12.5 times earnings, I think it's a bit of a bargain, really. So yeah, and I'm really impressed with the full year results.
One for the watch list?
I think so, yeah.
Should we move on to another retailer?
Yes, so it's one that we haven't covered for quite a while. It's WH Smith's, which is newsagents, but it's now largely focused on travel, and that has been the attractive attractive part of the business and what's been driving the growth in recent years. Anyway, they also had a trading update out last week, which was for the 13-week period to the 1st of June. And they announced that the group is on track to deliver full year in line with expectations, and it's being well positioned for the peak summer trading period, with trading momentum continuing across their key markets, with total travel revenue in the 13 weeks up to the 1st of June up 9% on a constant currency basis versus the prior year. And in terms of the total, group revenue, it was up 5% and 4% on a like-for-like basis. In terms of travel in the UK division continues to perform strongly, and it was up 9%, and that was on the back of higher passenger numbers throughout 2023, and total revenue was up 8% in air and up 14% in hospitals and 8% in rail stations. And the transformation of the business to a one-stop shop for travel essentials is delivering strong results, increasing average transaction volumes and returns. As part of their category development initiatives to expand the breadth and quality of their food-to-go ranges, they've recently launched a new food-to-go brand, Smith's Family Kitchen, in more than 300 of the travel stores. And so far, the customer feedback has been positive. North America, total revenue in the division has grown 5% on last year on a constant currency basis. Like-for-like sales were flat, with similar trends as reported in the interim results. And they're applying a forensic approach, they say, to the retailing across the North American business, with a range of initiatives, including rebalancing the space from lower to higher performing categories, increasing the range of snacking and confectionery, and increasing the number of chillers in store. And the early results from the initiatives have been positive, and recent trends have been encouraging. And during the period, they've won an important new contract at the Detroit airport, comprising of 4 new stores, and the tender pipeline remains very strong. In the rest of the world, the division is performing well. Total revenue was up 16% on last year on a constant currency basis, with passenger numbers continuing to improve across all of the markets. And they're saying that they're making good progress in growing the rest of the world business and continuing to win new businesses. The high street in the UK high street division, total revenue including online, was down 4%, and the store network performed well, with like-for-like revenue flat versus the comparative period last year. And they've successfully opened 5 new Toys R Us shop-in-shops within the stores. Early feedback has been good, and they say that they're on track to deliver a further 25 shop-in-shop in the balance of the financial year. An outlook, since their announcement on the 25th of April, their positive expectations for the full financial year are unchanged, and looking ahead, the group is well positioned as they enter their peak summer trading period, with good trading momentum continuing across all 3 travel divisions, and they say that they're in a strong position to capitalise on substantial growth opportunities across their markets. In terms of valuation, WH Smith has a market cap of around £1.5 billion and trades at 14 times earnings. I thought these results were pretty good. I mean, they've got what you might consider the legacy business of the high street stores, which aren't doing well, but from travel in the UK and the rest of the world, certainly positive. North America a bit disappointing. I think at 14 times earnings, you could definitely have better businesses, and I'd certainly rather have B&M over WH Smith, but they have recovered significantly since the lows of COVID, and I don't think it's a bad business. Sam, do you get excited by WH Smiths?
I don't. I know an investment doesn't need to be exciting to do well, but I just think, and again, I also know it doesn't need to be a business that you would personally use, but nothing about WH Smiths excites me. I can't think of a reason why I would ever go into one. And I know they've sort of tried to rebrand to travel, and you do see them in airports all the time, in fairness, but I don't think WH Smith and think travel. And I think for me, if that's the thesis on which I'm paying 14 times earnings for a business that's retail side is doing quite poorly, I feel like I'd need to think that, or think at least most people do think that, even if I don't. And all I really think with WH Smith is, well, they'll rip you off in the airport. And I know every single one does, but it just doesn't excite me. And I think in terms of that repositioning, in my mind, it's not really there yet. I think even if it was there, I don't think it's a business I would particularly be keen to own, because I just don't really see where the growth comes from. So yeah, it doesn't interest me.
Okay then, Hollywood Bowl.
Yes, so I think it's a debut on the show, although it is listed on the FTSE 250.
Well, I feel like maybe we've covered it once, but
I can't remember covering it, so we'll call it a potential debut. I know I do recall a listener requesting it once, fairly recently, actually, maybe, but it's definitely been requested, but I don't recall doing it. But anyway, we're doing it now. So Hollywood Bowl, obviously the bowling group that I'm sure everyone is familiar with if they've either been a child or had a child in the UK, have come out with their half-year results, and revenue is up 8.1% to 119.2 million. Group adjusted EBITDA is up 10% to 48.3 million. Group profit before tax is up 10.5% to 29.5 million. Group profit after tax is up 5% to 21.9 million. Adjusted earnings per share is up 6.2% to 13.6p a share. Free cash flow is up 7.8% to 16.5 million. Net cash is down 6.2% to 41.4 million. And the ordinary dividend is up 21.7%. So in the UK, where they have 71 centres, it feels like more than 71. They do seem to be in every high street. But anyway, they're claiming 71. They have completed refurbishments in Watford Woodhouse, Stockton, and Cardiff. They've refurbished in Lincoln, installed solar panels at 2 centres, and they've got a new centre in Dundee that opened in May 24. And the interesting bit is they also have 11 stores in Canada. So they've said the total revenue growth was 46.9% to 27 million Canadian dollars. And 2 centres were acquired. They built a new centre in Waterloo, or they started building one in Waterloo to be completed in June 24, refurbishing the Kingston site. In terms of valuation, they are trading at a P of 15 and have a dividend yield of 3.79%. Revenue is 215 million to September 23, and that compares to 129 million the year before COVID. Obviously, they had a big drop in COVID, but I think they're going for Canada, and that's where they're sort of trying to get their growth from. I think at a P of 15 and a yield of nearly 4%, it's not terrible. I just don't know what I think in terms of what the future of Hollywood Bowl actually is. I think if you compare it to maybe even 20 or 30 years ago, there's just so much more competition for children's attention now. I don't have kids, so I can only really compare it to when I was a kid, but I would have thought now children go bowling less regularly. I would expect they still go, but you would think it would be less regularly because there's just so many other options compared to maybe what there were. And I know they're expanding in Canada, but a lot of that growth is being acquired. Well, they've got a merger reserve, so I wonder if they must have merged with someone at some point over the COVID period. But I mean, it doesn't look like in the last sort of couple of years, it doesn't look like the debt's shooting up, in fairness. I mean, they took out a lot of debt during the COVID year, but I think we'll let them off for that. Whether that was the same year, I don't know whether that was the same year they started going for Canada, though. It looks like they've done some kind of merger. If anyone knows about it and wants to let us know on Twitter where basically, how they've funded all these acquisitions, we'd quite interested to hear it, because obviously in 10 or 15 minutes there's only so much we can look into. I can't say there's actually anything in there that would make me want to look any further. I just don't think I would want to be exposed to a bowling business, just because I find the future of bowling so difficult to predict. I know they've got arcades and stuff in there, but I think it is basically exclusively, if you're buying Hollywood Bowl, I think you are betting on the future of bowling. What about you, John?
Yeah, again, I wouldn't be convinced by the future of bowling, and therefore I wouldn't pay up for or want to own shares in Hollywood Bowl. But the results seem decent, but very difficult to know, I think. But like you say, going back to my own childhood, lots of birthday parties at Hollywood Bowl, and combined with a cinema and those two together. But I don't know. I feel like cinemas are struggling, and it's very uncertain future for bowling too.
Should we move on to a business that's much more predictable?
Absolutely, and one that we've been following the turnaround for some time of, and that's Tesco's. So I think it would be fair to say that it's our favourite supermarket on the show. We've been covering it for a while. It's one that I did own shares in. They had a first quarter trading update for the 13 weeks ended 25th of May, with overall retail revenues up 3.4%, and in the Booker division, which is the wholesaler, it was down 1.3%. We looked at some of the performance highlights then. So market share is growing ahead of all of the key competitors, up 52 basis points to 27.6%, supported by 15 consecutive periods of positive switching gains. Food sales were up 5%, including strong volume growth across the quarter, particularly in fresh food, and non-food sales were up 0.7%, driven by strong growth in clothing. They were the cheapest of the full-line grocers for 19 consecutive periods, through powerful combination of Aldi's price match on 700 lines and low everyday prices, with over 1,000 prices locked, and then also their club card prices. They had growth in all channels. Online sales were up 8.9%, driven by volume growth and a strong contribution from Whoosh. Finest sales continued to grow strongly, up 12.5%, and net switching gains from premium retailers for 22 periods. Ongoing investment in colleague hours, supporting further improvement in brand perception, customer satisfaction, and availability, which is up 1.5 percentage points year on year to 95.9%. In terms of ROI, 4 consecutive quarter of volume growth drivers with further market share gains, continued growth in market share up 59 basis points with 18 consecutive periods on positive switching gains, and growth in all channels. Food sales up 5.1% with fresh volumes particularly strong, supported by investment in the fresh proposition. On to Booker, continued underlying growth in core retail and catering following an exceptional performance last year. Core retail sales up 1% with further improvements in availability and 204 net new retail partners. Core catering sales were up 2.2% with new Fareham DC supporting increased capacity and volumes. Overall sales decline of 1.3% reflects continued tobacco market decline, with weakness in parts of the fast food market serviced by Best Food Logistics, and performance also reflects strength of the prior year comparatives. And in terms of Central Europe, sales growth driven by strengthened food volumes, positive customer response to sustained price investment, supporting growing food volumes up 2.8%. And going forward, the guidance as set out in the preliminary results from the 10th of April for the full 2024-2025 financial year, the group expect retail adjusted operating profit of at least £2.8 billion. In addition, they expect total adjusted operating profit from the retained Tesco Bank business of around £80 million, which includes a part-year amount of partnership income based on the completion of the transaction towards the end of this calendar year. And they expect to generate retail free cash flow within the guidance range of between £1.4 and £1.8 billion. In terms of valuation, Tesco had a market cap of £21 billion and trades at 11.2 times forward earnings, compared with a 10-year average of 12.5, and it has a prospective dividend yield of 4.5%. Again, I thought these Tesco results were decent. We've come to expect that they have really turned the business round over the last 5 years, particularly with Dave Lewis, but now continuing with Ken Murphy. And I think you're continuing to see them. Yes, the margins are much smaller than they were 15 years ago, but they're investing it into the business and they're dominating when it comes to market share. And I think overall customer experiences and having, being competitive on price are all helping that. So I think they're running the business much better. I think slightly disappointing with Booker, but to a degree, they can't really help the tobacco sales. And I think there was quite a lot, of a boom post-COVID. And then as cost of living has tightened as a wholesaler, it is more difficult to do well in that part of the business. So overall, I think it's quality company, I think reasonable valuation and a healthy dividend. So I think you could do a lot worse than Tesco's.
Yeah, I think that market share is just phenomenal. I agree there's nothing they can do about the tobacco sales at Booker. It's quite a small part of the business overall anyway, but I think it's very interesting in the context of what we've just been discussing with British American tobacco. They've still got some Central Europe as well in there. I assume they'll get rid of that. I mean, it's tiny, but I'm assuming that they're not going to stay in some random Central European country, wherever it is. But yeah, in terms of the core business, just fantastic. I think the results speak for themselves, really, in terms of that market share. It's just absolutely dominant when you consider you've got the traditional big four and then Aldi and Lidl and Tesco still have a whopping 27% or whatever it is. It's just absolutely ridiculous. I think in terms of valuation, it's not that. I suppose you'd have question marks over the growth, and I think we have seen it cheaper on the show. But I still think at 13, you can do a lot worse. But yeah, I probably did prefer it when it was at sort of maybe 10 or something, but yield's still 4%, which is pretty decent. But I think the valuation is probably fair. I think before it was just quite cheap.
Shall we move on?
Yes. So we are moving on to Upwork, which is the outsourcing business. So similar to Fiverr, which we covered last week, if you want to hire someone basically to do a job remotely, you can sort of find whatever you really want on there. They're the largest outsourcer. So they are bigger than Fiverr. I think they're sort of 2 or 3 times the size of Fiverr. They have come out with their Q1 results and revenue grew 19% to $190 million. And all these figures are in dollars. Their take rate was 17.7%, and that compared to 14.7% a year ago. It's still way off Fiverr's. Fiverr's was something ridiculous, like 32 when we covered it last week. Active clients grew 5% year over year to 872,000. I think Fiverr's active clients actually dropped off slightly, although the clients were spending more at Fiverr. Net income was 18.4 million compared to 17.2 million a year ago. And diluted earnings per share was 13 cents compared to a loss of 15 cents a year ago. Cash provided by operating activities were 5.7 million compared to cash used of 8.7 million a year ago. Adjusted free cash flow is 15.5 million compared to negative 11.6 million a year ago, and they repurchased 5.2 million shares of Upwork stock in the quarter. I think what's interesting with this is that they've started repurchases. However, when you look at the diluted weighted average shares outstanding, that's currently 139 to 141 million, it's saying, in the second quarter. And by the end of the year, it's actually expected to grow to 140 to 144 million. So I think all the buybacks are actually doing is stopping the further dilution on the stock-based compensation, which is a bit annoying, but that's life. I've used Upwork myself. I've used Fiverr as someone doing the hiring, but on Upwork, I have done it as someone doing the work. More back when I was a trainee, where I would just write articles on like cryptocurrency or investing or whatever else, and I could get like quite a decent hourly rate. I even used it as a teenager to write sort of blog articles about the Premier League for money. So I have used it for a number of years, although that was back when it was freelance, actually. But what was it called? Elance, it used to be called. That was it. But I've not used it for probably like 4 years, something like that, 4 or 5 years now. And my girlfriend's just graduated. She's looking at doing a PhD, but because she decided quite late she wanted to do one, she's probably going to be doing it not this coming year, the year after. So she's got like a gap. So she is looking at jobs. She's got a research job for the summer, and then she's looking at jobs for the rest of the year. So one of the options that I'd mentioned to her is, well, why don't you have a look at setting up an Upwork account? Because it's like you can just work as a freelancer. The sort of job she's wanting are to do with data analysis, which are quite hard to get into. So I said, well, if you just try and find something on Upwork, you can at least get experience for a year, and you never know, you might like it. So she's gone on there and had a look, and I just think it's quite interesting how the website's actually changed, and it's the same sort of core website. But I mean, firstly, in terms of data analytics, there's actually some very well paid jobs that she could be applying for on there. Whether or not she gets them is another thing. But in terms of like what she would get from a normal salary, if she was willing to do it full time and take a punt, she could possibly get more than she would be getting on a normal graduate salary, which I think is quite interesting. But then as well, they've got this thing now where they've introduced called Connects, where you have to buy these Connects and you basically use these Connects as like the internal currency in Upwork to apply for jobs. I think the reason they've done that is to stop spam. So you used to be able to apply for any job, even if you were completely unqualified. Whereas now the Connects are quite reasonably priced. And like if you get a job, you get Connects back and you get new Connects every month, but you've got like a limited number unless you pay for them, which I just think is really interesting, because what it does is it means that you can't go out and just spam 100 jobs, or you can, but it might cost you, I don't know, $50 or something. And if you're spamming a lot of jobs you're not going to get, it's just uncommercial. So I just think that's very interesting in terms of sort of when I looked at the Connects, it didn't seem like they were quite reasonably cheap to buy as well. And it didn't seem like it was a revenue raising exercise. It seemed like it was more to deal with spam. So I just thought that was quite interesting in terms of the usage. In terms of the valuation, the business trades at a P ratio of 30. It's 33 times operating cash flow, although the operating cash flow is trending up significantly. Yeah, so the operating cash flow in 2020 was 22 million, and that's basically doubled since then for the last 12 months. So that is massively trending up, but it's 33 times operating cash flow, 54 times free cash flow, but free cash flow has been affected by the buybacks, which we've covered. Just in terms of the financials as well, if you look at revenue over the last since 2020, which is I think the year it listed, over COVID it was growing less than Fiverr, and it's been a much steadier grower. It's sort of been plugging away at sort of 10-20% a year. But if you look at it now compared to 2020 revenue is 373 million. Trailing 12 months, it's now 719 million. So in terms of the growth, it's actually, because it's been more consistent, is actually now growing higher than Fiverr's. The active clients are still going up. I think a lot of the numbers are actually more positive than Fiverr's that we covered last week, which hasn't historically been the case when we've covered the two. However, Fiverr is significantly cheaper. I know you talked about taking a basket approach, John, last time, which I think does make sense. And I still do really like Fiverr based on what we saw, and I would sort of back it to get back to grow. But I think for a business that's growing 20% a year, to get it at 30 times earnings, and I think as well, it's growing at 20% a year, yes, but so much more of that 20%. If they had another 20%, it's going to be so much higher margin than what's already there, because a lot of it's just pure profit, really, because the platform's not changing. You might need more staff to deal with queries and stuff, but I think a lot of the extra revenue that's going to be added over the next few years is going to be higher margin than maybe what was there previously, because you would think a lot of the cost base is already fixed. It's probably not that, it's not like compared to somewhere that needs to open new stores or something. So I would think, given how much revenue has shown it's growing, given what the operating cash is doing, I actually think at 30 times earnings or 33 times operating cash flow, given what it could potentially do, the tailwinds for the industry, I really, really like it. And I think on the back of that revenue growth of 19%, the active clients growing 5%, I probably slightly prefer it to Fiverr, because I just think they're both pretty reasonably priced. I know Fiverr is incredibly cheap, but it's had a bit of a wobble recently, so you are taking a bit of a punt. But I think if you were to take a basket approach, I do really like both of them, actually. John, what about you?
I would say I like them both too. I think these were a very good set of results from Upwork. We have got used to seeing that. And I think from a valuation perspective, it's still obviously very expensive, but it's continuing to deliver. And I don't think it's the eye-watering prices that we saw during COVID. So I'm actually very close to probably taking a position in both of them. There is probably more to like about Upwork, as you say, but I think I wouldn't back one of the horses. I would just back both of them. I think I'd be most comfortable doing that. But it's a sector that I like a lot. And you think, exactly as you highlighted with your girlfriend situation, there's a huge appeal to it. And I think particularly internationally, and where you see those differences in terms of wages, particularly when you compare, say, the US and, for example, different software jobs, which might be outsourced to places like India, and I guess people doing some of that more on a freelance basis. There's a huge market, and it feels like it's got a long way to grow. So yeah, I think it is definitely one for me. in terms of the companies this week, I think it would be right up there at the top, I would say. And what would I have last? Probably Hollywood Bowl. But what do you think, Sam? Would it be your pick of the week?
I do like British American Tobacco, but I think that's just more in terms of the cash you're getting out of it. I am actually seriously considering adding to Upwork and selling Mercado Libre to fund it, just because I've done incredibly well on Mercado Libre over the years. I don't really follow it a huge amount anymore. And I just think in terms of valuation, it's risky. I do really like the business, but in terms of valuation, it's always been eye-wateringly expensive. I mean, for personal reasons, because I've got quite a lot of holidays, but I'm not really like adding new cash in at the moment for probably the first time as an adult for the next sort of 6 months. So if I want to buy more Upwork, I have to sell something. I might sell Mercado Libre to buy more of it.
Ooh.
I do really like, and I like Fiverr as well, actually, but I've only got so many things I'm willing to sell. So,
okay. Very good. Well, on that note, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.